Lately, I've noticed a number of myths and misconceptions about the three-fund portfolio, and in today's video, I want to walk through 10 of them, and actually I think it can be very helpful because it helps to really understand the core concepts behind the three-fund portfolio. And so that's what we're going to do today. Now, if you're not familiar with the three-fund portfolio, I did an entire video on it. I'll link to it below this video. But the idea is it's a very simple way to invest. You can have a totally reasonable portfolio with just 3 mutual funds or ETFs. One would cover US stocks, one would cover international stocks, and one would cover bonds. Just to give you an idea, I'm showing you a demo version of Empower, and I've put in here a 3-fund portfolio. We'll look at it here, and what I'll do is with Empower, you can drill down to just one account if you want to look at just one. So that's what I'm doing here. I'll make this move and make this a little bigger. And here are the 3 funds. VXUS is one example of an international fund from Vanguard you could use in a 3-fund portfolio. And then BND is a bond fund. And then VTI is a US stock fund. And that's a 3-fund portfolio, very simple. We can look at its asset allocation in Empower, and there it is. We can see the US stocks are the orange, international stocks are, I guess that's a yellow. And there's some bonds. There's even some international bonds, which may surprise some of you. BND actually holds some what are called Yankee bonds, issued overseas but in US dollars. But in any event, that's the 3-fund portfolio, very straightforward. By the way, I'll link to Empower and everything I'm showing you below the video, so let's dive right in. The first sort of myth is that the 3-fund portfolio, it's okay for beginners. But, when you've invested for a while, you sort of graduate to a more sophisticated portfolio. I don't think there could be anything further from the truth. The 3-fund portfolio is a very sophisticated portfolio. We shouldn't confuse simplicity and sophistication and some idea that if it's too simple, it's not sophisticated, right? Simplicity is the ultimate sophistication, and I think that's absolutely true here. This portfolio spans equities throughout the world. It spans all sectors within equities, and if you use, say, a BND from Vanguard as just an example, you've got a lot of US bonds, including government bonds, corporate bonds, even asset-backed, like mortgage-backed bonds. So it's actually a very sophisticated portfolio packaged in a very simple way. And so it's not just for beginners. And in fact, we have the majority of our portfolio in the 3 funds that I've just described, sometimes in a slightly different way, which I'll show you in a minute. And in fact, at the end, I'll talk about the misconception that this is not good for people in retirement. And I'll show you that in just a second. So that's number 1. Number 2 is that, with just 3 funds, it's not that diversified. Well, that's just not true. In fact, we can drill down. And for this, we could do it here, but I'm going to just pop over to Morningstar. This is VTI. And if we look at the portfolio, this is US stocks. We can see that it has exposure to all 10 sectors in the financial markets, from utilities to financial services, real estate. And if you can see it here, it has over 3,500 stocks. That's just one of the 3 funds. If we go to VXUS and look at the portfolio, we can see it's going to cover all the sectors as well. But look at this. It's got over 8,500 companies in this one fund. And then with bonds, you're going to see it's got over 10,000 bonds, maybe closer to 20,000. Let's take a quick look. Over 17,000 bonds, and you can see it here. You can see that while it stays away from high yield, that's riskier bonds, it's got wide diversification based on credit. It also has wide diversification, believe it or not, based on duration or the length of the bonds. And of course, if we come up here, we can see it's got government bonds, it's got corporate bonds, and some what they call securitized, mainly I think mortgage-backed bonds. But the point is, it's a very diversified portfolio. Don't confuse the number of funds you own with diversity. I've seen folks send me portfolios some expensive advisor has set up with 20 or 30 funds that aren't as diversified as a 3-fund portfolio. You can't determine diversification based on the number of investments you own. They are completely unrelated. You actually have to drill down into what you own, understand what it has invested in. The 3-fund portfolio is very diversified. Okay. The third myth is that it's one portfolio with a fixed percentage in each fund, and that's actually not true. You decide how much to put in bonds, how much to put in U.S. stocks, and how much to put in international stocks. We can come back to Empower, and you can see the percentages. This particular fund, which I just sort of threw together, and this was several months ago, so it's grown as prices have changed, but you can see it's got 50% in U.S. stocks. Up here we can see 20% in international stocks, and the rest in bonds. But that's just one allocation. You could make this more aggressive by holding less in bonds. You can make it more conservative by putting more into the bond fund that you choose to use. And of course, you can choose between the U.S. allocation for stocks and the international allocation for stocks. And so that makes the three-fund portfolio extremely flexible. A 20-year-old can use this saving for retirement, 4 or 5 decades from now. A retiree who's in their 60s, 70s, or 80s can use the three-fund portfolio. It might look very different than the 20-year-old's portfolio, but that's great. It's the flexibility of this simple portfolio. All right, number 4. Some would say it covers the total market. I've probably said that in a way, or I said it covers most of the market, but there is something to understand about it. On the stock side, the equity side, it pretty much does cover the entire market. There are technically some companies that don't qualify even for a total U.S. stock index fund, but none that would matter. As a practical matter, it covers the equity markets both in the U.S. and outside the U.S. It doesn't, however, cover the total bond market. So if you use a B&D fund, and we can go back to Morningstar to look at this. This is B&D, and it doesn't cover the total bond market. For example, you can see it has very little in municipal bonds, and it also doesn't have any in what are called high yield. They used to call them junk bonds, but we really shouldn't think of them as junk. It's just that think of it as from companies that maybe don't have as solid a financial standing as other companies. You would see them down here in the BB, B, below B, right down in here, but you can see it's all zeros. It doesn't have any exposure to that market. And I think it important as well, it doesn't have any exposure to tips. So that's important, and we're going to come back to that in a minute. So does it cover most of the market? Well, certainly that's true for equities, but for bonds, no, it doesn't cover the whole market. It has some places where it doesn't have exposure. It's important for you to know that. Now, again, that's assuming you use a fund like B&D, which tracks a Bloomberg U.S. bond index. As we'll see in a minute, we can address that if we want. And that actually gets me to the 5th misconception, and that is there's something special about three funds. Let me just tell you a little secret. There ain't. There's nothing special about three funds other than it's a relatively simple portfolio. That's the irony. We call it the three-fund portfolio, but the key to it is actually not investing in three funds. It's investing in a relatively small set of funds that covers, if not the entire market, a large segment of the market. But here's the thing. We can have a three-fund portfolio using just one fund, right? I'll show you an example. We'll pop over here. We'll use a Vanguard's Life Strategy Fund. So they have several. This particular one is 60% stocks, 40% bonds. And you'll notice here's what it holds. And you say, wait a minute, Rob, it's one fund. So that's not a three-fund portfolio. And it owns 4 funds. So that's strike 2. Yeah, see, it doesn't matter. The point of the three-fund portfolio is not to actually own 3 funds. That's how it was first implemented. But this is effectively, in concept, a three-fund portfolio. You put all your money in one fund. I probably wouldn't use this in a taxable account, but in a retirement account. And yes, it's true, Vanguard's going to divide it into 4 funds, not 3. The reason they have 4 is because this fund at the bottom, they have exposure to international bond funds. I don't personally feel a strong need to have that, but I would be perfectly fine with it. And in fact, we use a Vanguard target date retirement fund that does have exposure to international bonds. I think that's fine. So here's a one fund solution that, at least in concept and principle, implements a 3-fund portfolio. You could do it with 2 funds, right? We could use B&D for our bonds. We looked at that just a second ago. And then for the stocks, we could just use VT. That's another Vanguard fund. But this one invests all in one fund, both in U.S. and international companies. So you wouldn't need two funds for your stocks. You could just use VT. What are the advantages and disadvantages? Well, the primary, I don't know if it's an advantage or disadvantage, depends on your perspective. If you use VT, then you accept their division between U.S. stocks and international. You can see it here. U.S. stocks is about, we'll call it 63%, and non-U.S. stocks about 36%. So if you use VT, you get the simplicity of having one fund instead of two. You don't have to rebalance between the two stock funds because all the rebalancing will happen inside this fund. But you have to be okay with that U.S. to non-U.S. Division there, as you see, 63 to 36 or so. And but yeah, you could do it with two funds, right? You could even do it with three funds, and with four funds, and I'll come back to that in just a minute. All right, number 6. Some will say, well, wait a minute, Rob. You said this is diversified, it covers the market, but I don't see any REITs in there. I don't see any commodities, and I know you're not a fan of crypto, you might say, but some of us might want some exposure to Bitcoin. I don't see any Bitcoin in there or crypto. Well, actually, there is all three of those things, right? Because, and I can just show you an example of some of them. If we go back to VTI, it has real estate. Now, it doesn't have a ton of real estate, 2.5%, but there are REITs inside both the S&P 500 index and a total U.S. market index. And so there absolutely is exposure to real estate. And that doesn't count companies that might not be designated as part of the real estate sector, but still have significant exposure and assets in real estate. And of course, there are plenty of companies in here that are heavily influenced by the price of commodities, right? You think the energy companies, there are oil companies. Think of something like Deere and Company. They sell tractors, but they are heavily influenced by the price of food commodities, right? Corn and soybeans and that sort of thing. So it absolutely does have commodities, and there are companies in the index that are heavily influenced and have Bitcoin on their balance sheet, or that make money through crypto. So again, it's a totally diversified portfolio. Now you may say, well, Rob, that's fine. Technically, you may be right, but I want more exposure to one or all of those things. Okay, you could do that, and we'll come back to that in just a second. All right, number 7. This one really gets me. It's fine for you beginners, maybe for the folks who don't have a lot of money, but if you're wealthy, well, you've got to have a much more complicated and sophisticated portfolio than just some 3-fund portfolio or a handful of index funds, and that's just a bunch of hooey. Yeah, that's a technical term. I mean, it's just really utter nonsense. In fact, Warren Buffett himself said for most folks, he didn't propose a 3-fund portfolio. He just said you should have S&P 500 index and some treasury bills. And that was Warren Buffett, probably the most, sophisticated, certainly successful investor of our time. Yeah, this idea that if you have a lot of money, you have to invest in all of these exotic things, all these complicated strategies, it's just utter nonsense. Now, of course, if you have far more money than you need, you can invest it however you want. Certainly, if it, maybe out of interest or just makes you feel better, you pursue some of these more complicated investment strategies, you can do that. But do you need to do it? I would have absolutely no qualms at all putting $100 million. By the way, I don't have $100 million, but if I did, in a life strategy fund or a target date retirement fund or a handful of low-cost index funds, no problem putting $100 million into these types of funds. So this idea that the 3-fund portfolio is not for the really wealthy, that's just nonsense. Okay, number 8. That you have to use Vanguard funds, and you don't. Now, I talk a lot about Vanguard funds. I've shown you several today. I think that comes from the fact that the Bogleheads, really sort of promoted the 3-fund portfolio. If you don't know, the Bogleheads are named after the late Jack Bogle, founder of index funds in Vanguard, and I think the Vanguard index funds are terrific, but you don't need to use Vanguard funds. In fact, let me show you this again. I'll link to everything below the video. The Bogleheads, their own website, has a page on 3-fund portfolio. And if you come down here, they list how you can build this with Schwab Mutual Funds, Dreyfus. Does Dreyfus even exist? Anyway, Fidelity, T. Rowe Price, the Thrift Savings Plan right here. And then down here they have ETFs. So, and not only do you not need to use Vanguard funds, you can mix and match these. I guess if you wanted to, you could have a Schwab fund and a Vanguard fund. I even think, although they're not listed here, I think DFA, Dimensional Funds Advisor, and it would be perfectly fine. They're not technically index funds quite in the same way as, say, a Vanguard fund. Avantis is another one, but I think those would be reasonable options as well. So yeah, you don't need Vanguard funds. All right. Number 9, it cannot be customized to individual needs, this idea that you just got to have these 3 funds, and that's just not true. You know, I mentioned before REITs, commodities, even maybe some crypto. If you have a strong belief that you want to tilt your portfolio, you want to have a little extra exposure, you can take the 3-fund portfolio and then add some, maybe a REIT portfolio or a commodities portfolio. Some would add a small cap or small cap value portfolio. You can do those things, and for many years I did. Today, I have a small cap fund that I've added to our portfolio. The other one that I think can be really important is a TIPS fund, because as I mentioned, B&D doesn't hold Treasury inflation protected securities, so I like to have some exposure to TIPS. And so you say, well, Rob, it's not really a 3-fund portfolio. It's a 4 or maybe a 5 fund. Yeah, that's right. And if you think that's best for you, that's terrific. Remember, it's not really about the 3 funds. Right? It's the concept and principles behind it that really matter. Okay, number 10, I think a lot of folks think that this might be fine while you're saving for retirement, but once you retire, it doesn't really work because you need income-producing investments. And again, that's just a bunch of hooey. I know, I've used that technical term twice now. You don't need special kinds of investments to generate income once you retire, even as you're pulling money out to spend it. And let me show you, I think there's really 2 important things to keep in mind here. First of all, in the 3-fund portfolio, you are getting dividends and interest. This is VTI. You're going to get about, the yield's probably around 1.2%. Let's see. Here it is, 1.14. Not a lot, I understand, but then we go to VXUS. It's, let's see here. Its yield is, they hide things now. The trailing 12-month is 274, so that's higher. And then B&D is going to be higher than that. Let's see. We've got, there we go. That's yield is 417. And so if you had just these 3 funds, you would be getting dividends and interest that you could live off of. Now you might say, well, Rob, that's fine. 4%'s not bad, but it probably wouldn't be enough. And here's where I would say that's fine. It's okay to sell shares. I know a lot of folks get really nervous about selling shares, but just kind of zoom out for just a second. Let's say you've got $1 million in your account and you're going to spend $40,000 of it this year. I don't care if that $40,000 comes from dividends or comes from selling shares or some combination. $1 million minus $40,000 is still $960,000. That's what you're going to have. And let's imagine you had to sell some shares to generate that income, maybe along with some interest and dividends. And so you're down to $960,000. And then your portfolio is up 10% the next year. You're going to be up what? About $96,000 in that year. And it's not going to matter to you, I don't think, that you own fewer shares because a year ago you had to sell some. I mean, at the end of the day, your portfolio is worth a certain amount of money. And you pull X dollars out of it, it's going to be worth that much less. And whether that money is sitting in cash because 2 months earlier a stock fund paid a dividend, or you have to sell shares, the same amount of money is coming out of your portfolio. It just doesn't matter. Now, I'm not suggesting you can't do other things like have a TIPS ladder or another bond ladder or a CD ladder, right? But we really kind of need to not get hung up over the yield on our portfolio. I think it can cause us to make a lot of mistakes with our portfolio. Personally, I think a 3-fund portfolio, perhaps with some of the other things we talked about, if that's important to you, like a TIPS fund or maybe a REITs fund, can be an excellent portfolio inside retirement. So that's my take on it. Let me know what you think in the comments below. I'll be happy to help you out any way I can as well. Again, I'll link to everything I showed you below the video. And until next time, remember, the best thing money can buy is financial freedom.